Your property tax bill arrived. You looked at it. You felt that familiar weight in your chest. You wrote the check, or you set up the payment, or you watched it come out of your escrow account, the same way you have done it every single year for as long as you have owned your home. And you assumed that was the only option available to you. It was not. Every single state in the United States, all 50 of them, has a formal legal program that reduces, freezes, or in some cases eliminates property tax obligations for homeowners aged 65 and older. Not a proposal. Not something being debated. Law that is already on the books, already funded, and already waiting for you to file a single piece of paper to claim it. According to a 2026 state-by-state analysis published by PropertyTaxRates.org, the typical annual savings from a senior property tax exemption on a medium-priced home ranges from $1,200 to $4,800 per year depending on the state and the specific program. Over 20 years of retirement, that is between $24,000 and $96,000 that either stays in your household or gets handed to your county because nobody told you to ask for the exemption. And the number that makes this situation genuinely serious: most seniors who qualify have never applied. Not because they were turned down. Not because they investigated and found they were ineligible. Simply because the county assessor's office that calculates your tax bill has no legal obligation to tell you about the discount you qualify for. They send the full bill. They wait. And if you pay it, every dollar stays with them permanently. If you are 65 or older and you own your home, you are about to find out exactly what the government has already decided about your property tax obligation, and exactly what it is going to take to start collecting what is legally yours. Before getting into the specific programs, there is one thing about the property tax system that most homeowners have never been clearly told, and it explains why millions of qualifying seniors are still overpaying right now. Property tax exemptions in this country are not automatic. They do not activate when you turn 65. They do not trigger when you file your income taxes, or when you apply for Medicare, or when you begin receiving Social Security. There is no government system that cross-references your age and your property records and sends you a lower bill. The entire system is claim-based. You file an application. You provide documentation. The county assessor reviews it. If approved, your exemption takes effect, typically beginning with the next tax year after your application is approved. If you never file, you never receive the benefit. The law that was written to protect you sits unused. Your neighbor in an identical home who filed the application pays significantly less than you every single year. And the county keeps the difference. The Lincoln Institute of Land Policy, which has studied property tax relief programs across the United States for decades, has consistently found the same pattern in its research. A significant portion of seniors who are not enrolled in property tax relief programs are not enrolled simply because they assumed they would not qualify, or they did not know the programs existed, or they believed someone else would notify them when it was time to apply. None of those assumptions are correct. The responsibility sits entirely with the homeowner. And in most states, once the annual application deadline passes, the savings for that year are gone permanently with no ability to recover them retroactively. The programs themselves come in 4 distinct structures, and understanding which ones your state offers changes what you should be doing right now. The most common form is the exemption. This reduces your home's taxable assessed value by a fixed dollar amount before your tax rate is applied. The reduction goes directly to your bottom line. Lower assessed value means a lower tax bill, dollar for dollar, every year you maintain the exemption. In Florida, senior homeowners aged 65 and older with annual income below approximately $35,000 qualify for an additional exemption of up to $50,000 on top of the standard homestead exemption. Combined, qualifying Florida seniors can shield up to $100,000 of their home's assessed value from taxation. At Florida's average effective property tax rate, that translates to between $1,000 and $1,500 in annual savings that have been available for years to seniors who never filed the application. In South Carolina, homeowners aged 65 and older receive an additional $50,000 exemption stacked on top of the regular homestead exemption, providing a combined $100,000 total reduction in assessed value. In New York, the Enhanced Star program for seniors aged 65 and older with income below $110,750 in 2026 reduces the school tax assessed value by $70,700, with school tax savings typically running between $1,500 and $3,500 per year depending on the school district. The December 2025 state law now also allows New York localities to choose to increase the local senior citizens exemption up to 65%, meaning some New York seniors are sitting on newly expanded relief that most of them have not yet claimed. The second structure is the assessment freeze, and this is arguably the most powerful protection available to senior homeowners, and the least understood. An assessment freeze legally locks your property's taxable assessed value at whatever it was when you first qualified. It does not matter what happens to the real estate market after that. It does not matter if your neighborhood doubles in value over the next decade. Your taxable base stays exactly where it was frozen on the day your application was approved. The financial significance of this over a long retirement is enormous and largely invisible until you calculate it directly. In Texas, voters approved Senate Bill 4 and Proposition 13 in November 2025, raising the school district homestead exemption from $100,000 to $140,000. Combined with the existing over 65 tax ceiling, which freezes school district taxes at the level paid in the year the homeowner turns 65, qualifying Texas seniors in 2026 are receiving the most comprehensive property tax protection the state has ever offered. The school district tax ceiling means that even as home values rise and tax rates fluctuate, the school tax portion of a qualifying senior's bill cannot increase. It is locked permanently for as long as they own and occupy the home. In Arizona, the Senior Value Protection Program freezes the assessed value of a qualifying senior's home for 3-year periods, renewable as long as eligibility is maintained. Income must be below the program's threshold, and the homeowner must have owned the property for at least 3 years. In a state where desert real estate markets have seen dramatic appreciation over the past decade, a frozen assessed value can represent savings that compound significantly year after year. Illinois raised its senior freeze income eligibility threshold beginning with the 2026 assessment year. The new income cap for the Senior Citizen Assessment Freeze Homestead Exemption now allows more middle-income seniors to qualify than ever before, but as with every other program in the country, it requires a filed application, and the expanded eligibility is not being communicated proactively to seniors who may now qualify for the first time. The third structure is the circuit breaker credit, and this is the one that most consistently catches seniors off guard, because it operates completely differently from what most people think of as a property tax break. A circuit breaker credit does not reduce your assessed value. Instead, it steps in when your property tax bill becomes disproportionately large relative to your income, essentially acting as a relief valve when the tax burden exceeds what is considered reasonable for a fixed-income household. Most circuit breaker programs calculate the credit based on the ratio of your property tax bill to your total household income. When that ratio exceeds a certain threshold, the state issues a credit, either as a reduction in your current bill or as a direct reimbursement after payment. New Jersey's Senior Freeze program operates on a similar principle. It reimburses qualifying seniors for any property tax increase above their base year amount. The income limit for New Jersey's program in 2026 extends to approximately $150,000, significantly higher than most seniors assume, meaning a large portion of New Jersey retirees who have never looked into this program may actually qualify. In a state where property taxes are consistently among the highest in the nation, this reimbursement can run into thousands of dollars per year. Washington State Senate Bill 6162, currently advancing through the legislature in 2026, will expand and streamline the state's senior citizen property tax relief program while increasing the exempted assessed values for qualifying homeowners and creating a standard deduction option for calculating disposable income, a change that would allow more seniors to qualify than under the current framework. The fourth structure is the deferral program, and this is the option almost nobody talks about, but that represents a genuine financial lifeline for seniors in serious cash flow difficulty. A deferral program allows qualifying senior homeowners to stop making property tax payments entirely while they continue to live in the home. The deferred taxes accumulate as a lien against the property, typically with a modest interest rate, and are paid from the estate when the home is eventually sold or transferred. Oregon and Minnesota operate deferral programs with no income cap, meaning the program is available regardless of how much a senior earns, as long as they meet the age and residency requirements. For a senior homeowner who is asset-rich but cash-poor, sitting on a home that has appreciated significantly but living on a Social Security check that barely covers monthly expenses, a deferral program eliminates the property tax payment entirely until the home is sold. This option exists in multiple states. Most seniors who would qualify for it have never heard it was available. There are also specific mistakes that quietly wipe out eligibility, and they happen constantly among seniors who thought their exemption was secured. Adding an adult child to the deed of your home is one of the most common. This happens frequently when aging parents add a child's name for estate planning convenience, without realizing that in many states, Adding a co-owner who does not meet the age and residency requirements can trigger a full reassessment of the property and eliminate the senior exemption entirely. Some states allow exemptions to continue when the property is transferred into a revocable trust, but others do not. The safest approach is to consult a tax professional before making any changes to how your deed is titled. Missing the annual recertification requirement is another. Some programs require new filing each year to maintain the benefit. Seniors who received their exemption, assumed it continued automatically, and never filed the annual renewal have been quietly dropped from programs, sometimes for years, without any proactive notice from the county. And perhaps the most consistently damaging mistake of all involves mortgage escrow accounts. When your property taxes are paid through your mortgage services escrow account, a reduction in your tax bill does not automatically flow through to a lower monthly payment. The servicer continues collecting the old amount until they receive notice of the change and conduct an escrow review. Seniors who have successfully obtained an exemption but never notified their mortgage servicer have continued paying the pre-exemption amount for months, sometimes longer, while the county holds a credit balance that the servicer has not yet applied. If your property taxes are escrowed, the moment your exemption is approved, send the approval notice directly to your mortgage servicer and request an escrow review in writing. Do not assume they will find out on their own. They will not. The deadline situation is something that requires immediate attention for anyone who has not yet filed. Filing deadlines for senior property tax exemptions vary by state, but they cluster around specific windows that are already open or approaching right now. In Florida and New York, the primary deadline falls on March 1st. Pennsylvania's property tax rebate program deadline for the current year is June 30th, 2026. California's postponement program window closed February 10th, 2026 for the current cycle, meaning seniors in California who have not yet applied will need to file for next year's cycle when it opens. In most states, missing the deadline for a given tax year means losing the savings for that entire year with no ability to recover them. The application you file after the deadline takes effect for the following year, but the year you missed is gone. Every year that has passed since you turned 65 without filing your application is a year of overpayment that the county has already collected and will not return. The only direction this can move from here is forward, and the only way to start saving is to file. Here is the complete picture of what the government has already decided about your property tax obligation. Every state has a program. Every program requires an application. Every application is free to file. Every exemption, once granted, reduces a bill you have been paying without reduction for years. And in states with assessment freezes, the benefit compounds every single year as home values rise around you while your taxable base stays locked. The county assessor's office that sent you this year's bill is not going to call you. The mortgage servicer collecting your escrow payment is not going to flag the exemption you have been missing. The state revenue department is not going to cross-reference your age and send you a notice. You have to go find it. You have to file for it. And you have to do it before the deadline for this year passes. Go to your state's official Department of Revenue or Department of Taxation website today. Search the words Senior Property Tax Exemption along with your state name. Find the official program page. Download the application. Gather your proof of age, proof of residency, and any income documentation required. And file it. One application. Potentially thousands of dollars every year. For the rest of the time you own your home. The proof that the government already exempted you is sitting in your state's tax code right now. The only missing piece is your signature on the application. This video is for educational and informational purposes only and does not constitute financial, tax, or legal advice of any kind. Property tax exemption programs, income limits, deadlines, and eligibility requirements vary by state and county and are subject to change annually. All data cited is sourced from publicly available state government sources, propertytaxrates.org, the Lincoln Institute of Land Policy, and official state tax authority publications current as of 2026. Always verify current requirements directly with your county assessor's office or State Department of Revenue before filing.